global markets' performance has been quite divergent so far this year. Still, all major indices exhibited resilience during the near-war conflict between Iran and Israel and even the brief closure of the strategically important Strait of Hormuz. Crude prices, after a sharp rise, have resumed a downward move, reflecting the reduced dependence of the world on crude as well as the Middle East to meet that demand. In the US, the new tax law is set to widen the fiscal gap by $3.3 trillion over 10 years, and the current account deficit is also widening to 6% plus, which underscores twin deficit risks amid a softening dollar. Trade deals have started to be finalized. However, for major trade partners of the US, including India, the EU, etc., negotiations are taking longer than expected, and hence, the uncertainty over this event may spill over one more quarter. Closer home, India's services export engine, early PLI payoffs, FTA with other countries and benign crude are expected to reduce the impact of tariff imposition, even as headline GDP growth remains in the range of 6.2 to 6.7%, supported by consumption and government spending. While overall macros look stable, high-frequency indicators are providing a mixed outlook from a near-term perspective. FII flows have been positive but modest over the last 3 months, while net flows in equity mutual funds have also witnessed some slowdown. Over the last 63 months, data on monthly FII flows indicate that FII outflows lead to negative monthly returns in 21 out of 23 negative months, or roughly 90% of the time, regardless of DII's remaining net buyers. Valuations have also risen sharply across the market cap and sectors. However, we stay constructive given pockets of high growth opportunities which are visible, and also the fact that soft and stable dollar is always positive from FII flows perspective. The temperature gauge index remains in the fair value zone. Last 1 month saw heightened geopolitical uncertainty due to Iran-Israel conflict and concerns over tariffs. Despite these, global markets remained resilient and some of the major global equity indices hit new all-time high. Investor sentiment received support from stable bond yields and rate cut expectations in the US and EU. However, the market seems to be losing some momentum now after a sharp rally during the last 3 months amid tariff imposition deadline moving closer. India's macroeconomic environment remains robust with stable growth, softer inflation, controlled deficits, and strong forex reserves. However, high-frequency indicators are providing mixed outlook from a near-term perspective. Valuations have risen meaningfully after a sharp rally. The Nifty 50 now trades above its long-term average on a 1-year forward PE basis. The mid and small cap segments, while supported by earnings growth, still command a significant premium. Stock selection is the key as pockets of high growth opportunities are also visible. Considering the confluence of micro, macro, and market's current situation, we believe that this phase is like the middle overs in a limited over cricket match. Hence, going through this phase requires strategy and patience, rather than aggressive striking. Risk should be managed while momentum should be maintained. Equity portfolio allocation stance, neutral, i.e., 65% allocation to large caps and 35% allocation to mid and small caps. Investment strategy, lump sum investments in hybrid funds at current levels. For pure equity-oriented strategy, a staggered SIP/STP approach is prudent given elevated valuations and higher volatility. Any sharp correction should be used for aggressive deployment. In fixed income, the yield curve has steepened over the last 3 months due to the RBI's actions on the rates and liquidity front. RBI is now in a mood to curb excess liquidity, and hence, further OMO purchases may not happen. FII flows have also been negative in debt for the last 3 months, indicating profit booking as US and India 10-year spreads narrow to less than 2%. Proactive measures by RBI on policy easing and liquidity have resulted into steepening of the yield curve. Hence, in our view, one may be overweight on accrual strategies across the credit spectrum. Due to limited room for further capital gains, softening of the yield should be used an opportunity to gradually reduce the exposure from long-duration 10 to 15-year segment. Accrual can be played across the credit spectrum by allocating 45% to 55% of the portfolio to performing credit and private credit strategies, in VEETs and select NCDs. 30% to 35% may be invested in performing credit strategies (NCDs) and in VEETs. 20% to 25% may be invested in private credit including real estate, infrastructure strategies and select NCDs. 25% to 35% of the portfolio may be invested in arbitrage funds, minimum 3 months holding period, floating rate funds, 9 to 12 months holding period, absolute return long-short strategies, minimum 12 to 15 months holding period. Income plus arbitrage fund of funds, minimum 2 years holding period. For tax-efficient fixed income alternative solutions, 20% to 25% of the portfolio may be allocated in conservative equity savings funds, minimum 3 years holding period. Gold is gaining strength on back of increased central bank buying and nations moving away from the dollar. We are neutral on gold from asset allocation perspective.